Turbulence in global stock markets has caused collateral damage to the Aussie dollar, knocking it to 6-week lows. Steep falls in US equity markets have dominated headlines over the past week, with the selling spilling over to global markets, including Australia. Some of the fall is probably just due to automatic sell orders, but behind it all, the sell-off seems to have been sparked by a fundamental factor. In particular, equity investors seem to have been rattled by the surge in wages reported in the January employment numbers. Now, the report overall was really quite encouraging, with 200,000 new jobs in non-farm payrolls report and the unemployment rate remaining at 4.1%. But equity markets seem to be rattled by the acceleration in wages growth in the report to 2.9%, the fastest since 2009. Now, of course, in itself, that's good news, but equity investors seem to be concerned that it will mean that US interest rates rise faster than expected. And indeed, what we have seen is an increase in market yields in the States, particularly the US 10-year Treasury, which has risen above 2.80%, and that's the highest since early 2014. Equity markets, of course, hit record highs in January, so we're perhaps vulnerable to some bad news. And it does seem as though markets are concerned that investors will find these higher yields attractive and switch away from equities. Indeed, Fed officials over the past week have been brushing aside the market volatility and insisting that they intend to continue to raise interest rates. Interest rate markets in the US continue to price in 2 or 3 rate hikes from the Fed this year, including a March increase, which is roughly 80% priced in. In contrast, in Australia, this week we heard from the Reserve Bank for the first time this year as its board met on Tuesday. As fully expected, the cash rate remained at 1.5%, and the statement indicated that there would be no change in rates for some time. The RBA remains quite positive on the growth outlook, looking for the Australian economy to grow by 3% or more over the next couple of years, but it does concede that inflation is not very threatening at the moment, so there's no real case for a rate hike. Markets price about a 2/3 chance of the RBA raising the cash rate by December, but Westpac remains of the view that rates will be on hold for the whole year. So steady interest rates in Australia contrast to rising interest rates in the US, one of the factors that's been undermining the Aussie dollar over the past week. The Aussie's down about 3%, hurt by broad US dollar strength, the equity turmoil and patchy commodity prices. In the week ahead, the global focus will of course remain on equity market sentiment, but also in the US we'll see January readings on consumer prices and retail sales. Australia has quite a busy calendar. It includes business confidence, consumer sentiment, and the always important employment report. We will see whether in January Australia's strong job creation of recent months continues. If US Federal Reserve officials continue to talk about higher interest rates and global equity markets remain nervous, then the Aussie dollar is likely to remain under pressure. It's likely to fall towards the 76.50 or 77 cent range in the week ahead. We'll speak to you next week.